Hello, everyone, and welcome into CrushTheStreet.com. I'm Kenneth Amaduri. I just got off a call with Frank Holmes of U.S. Global Investors, and it was a powerful call, I will tell everyone. And one of the things that I will let people know is right now, in the middle of this crash, in the middle of this pandemic, it's very difficult for humans to make responsible, prudent decisions. It's very difficult to decide what you need to do at your house, where to live. If you are to hold stock, sell all your stocks, sell your gold, buy Bitcoin, sell your Bitcoin, because right now the extremes are being seen. And the problem is the economy is coming to a grinding halt, and that is fearful for people's paychecks. You know, what is the world going to look like in a month? Are you going to be able to pay your bills in the next few months? And it really reminds me of, like, you know, trying to swim across the Mississippi River, you know, from one end to the other. I mean, if that's even possible. You know, if you get to the other side, you're okay. You were resilient. You got through it. But, you know, if you gave up midway through, you're drowning. And that's what this is going to be. I mean, it's going to be about getting through this crash, this depression, this reset. And it's going to take a lot of concentration, fortitude, resilience, perseverance to not make decisions in these moments that are going to put you at a disadvantage when things start to bottom out, things start to settle out, and things do eventually go back to normal. But that grind that we're going to see up until then, that's the swim. That's the perseverance. That's the resilience that each and every one of us are going to have to put out. And so I want to encourage everyone, be strong. Everyone knows their financial situation, their medical situation, their emergency food supply situation. I mean, now is the time to be prudent in these moments. And I want to recommend everyone to go to crushthestreet.com/V1. It's A to Z report on what is happening on the coronavirus. And without any further ado, let's get right into this hard-hitting interview. Hello, everyone, and welcome into CrushTheStreet.com. I'm Kenneth Amaduri, and I'm joined today with a returning guest, someone that we seek for advice, for information, to understand the world around us, and maybe he'll put some of us at peace with what is going on right now, because it is quite the chaotic market at the moment, from the financial markets to what we're seeing on Main Street. I was at Target this morning walking around, and it really felt like a depression. I mean, people were not smiling at each other. There was this, you know, concerned look over people's faces, you know, looking at the shelves empty and bare and the essentials gone. This is a time that, you know, I think a lot of us are looking around, and it feels like a very weird dream. So it's a special time to have Frank Holmes on. He's with U.S. Global Investors. His website is usfunds.com, and he's also the interim executive chairman from HIVE Blockchain Technologies. We're going to be talking about the crypto markets today. We're going to be talking about precious metals. We're going to be talking about the equities markets, and maybe he'll give us some thoughts on his sentiment on the coronavirus and what we're seeing today. So, Frank, thanks so much for coming on Crush the Street with me today.
It's great to be back with you, Kenneth. And yes, it's a very different market. I remember as a young man, I first got in the business and had my first big crash, really was 87. And the world shut down. The stock market shut down. Canada was shut for a week. US, I believe it was about 3 days. We saw Hong Kong shut for 2 weeks. And that was triggered by the leverage of the futures market. They just the systems couldn't handle this perpetual selling through futures and then realigning. And when they finally solved it, the market surged back. The economy wasn't harmed. It was really a stock market crash that excluded the economy. But 2008 was different because it was a credit cycle. It was where people had homes where they only put down 5%. Therefore, a 5% decline in a house price wiped out your principal. You had people buying furniture with for these homes. Everyone was getting rich on homes. Not Frank Holmes, but Homes. And what's interesting about that is that when you have a credit crisis, or going back of history of 400 years, it takes about 4 years to resolve itself. So that the 97 crisis in Asia became in 98 was the Russian defaulted on their sovereign bonds. By 2001, 2002, we had a real bottom, and that launched the great commodity cycle. Then we turn around and we have the crash of 2008 and 9. So then you have to go about 4 years basically because of a credit crisis, and the economy start taking off again. So this is very different. This to me is much more like 87, but it's created by something outside rather than a government policy internally. This whole the pandemic and the fear of it and the unknown of it and so many unknowns create a sort of a backlash. So in digging down, what I found was interesting. There's not that much research on the Spanish flu, which impacted the world and killed more people than World War I and II, but there's really not that much in the history books. And so why did that take place? Well, that was global travel, but it was soldiers. And the Spanish flu really hurt predominantly men between 20 and 40 years old. This flu is hurting people over 60. It is hurting smokers. It is hurting obese people. It is hurting places where there's lots of pollution. So it's a different animal, but because of globalization and travel openly around the world, all of a sudden this virus starts to spread rapidly. And what you find in America is that we don't have enough beds. There's like 1 million beds to deal with 300 million people. And so that is what they call trying to squash the bell curve of trying to get everyone separate, no one really be in groups more than 10. So therefore, the hospital system can handle this pandemic. And unlike other times, so what they had to do in China was amazing because they shut down a city of 11 million people. They quarantined the whole city. And then they basically put air spray to kill this virus that might be attached to any clothing or walls or anywhere. And then they started sending food by robotics to keep people going. And they got control of the process. They built hospitals, the fastest hospitals ever built. I think what we're going to see in America is hotels are laying off people, and maybe these hotels become interim hospitals. And I think the idea of shutting down travel, that's very, very important. And I think the idea of less than 10 people congregating, more than 10 people is a very smart idea because Europe had open borders. And Europe is really seeing, especially in Italy, where socialized healthcare is really quite poor, unless you have the two-tier system. You're seeing that older people are being afflicted, and under social free healthcare in Italy, everyone smokes. So the smokers are being afflicted. There's not enough hospitals really to deal with the issue. And this sort of free open borders is now showing up in Switzerland and Germany. Last night, they shut down all the supermarkets in Switzerland. People are in Vienna. Everyone has to work from home. It's much more severe there because they've lost total control. I think America is doing the right thing, but it'll have to move just a little faster in educating people as we and this economic support system is very strong in America. We're talking about $50 billion for the airlines, and we're going to probably have to see $200 billion going into it. But the G20 countries are basically now operating as a cartel. They all speak to each other, and they're just going to print so much money, Kenneth, and they're going to put money into the system because in 1920, they didn't. In 1920, they had rising interest rates. That led to a depression. There's not going to be a depression there in this. They're going to have a big economic slowdown. The trough is going to be between now and May. The president believes it could be July or August, but I think it could be earlier. And I think that people just have to be really conscientious of cleaning themselves much more often. But we do have an educational problem when you think that 40% of Americans think that Corona beer is associated with the coronavirus. So we have to go and educate people that that's not the issue. And I think you're going to get great buys and a real surprise to me, but very positive, has been close to a couple $100 million has come into our JETS ETF. As it fell, and because the airlines industry has a moat around it, and Warren Buffett announced that 10 days ago he was increased his position in Delta. You're seeing that money is coming in looking for to buy it. It was on Bloomberg last week that only in ETFs that are cheaper on a PE ratio are Nigeria and coal. So I think the airline industry is for the deep value conscientious person that in a year from now would probably be very happy investors being contrarian.
Frank, so a lot was said there. I want to address the situation right now with the Fed. It really does feel like they're pushing on a string. They're throwing trillions of dollars at the markets. They're lowering interest rates. And in the face of that, we're seeing stocks, totally blow through that. It essentially fall through the floor. What are your thoughts on that? I mean, is this situation contained? I know and just juxtaposed to what you just said. I mean, obviously, they seem to be doing everything they can. We know there's more they can do. I mean, there's different rabbit holes. There is more ammo if the Fed wanted to go that direction. But it does almost feel like we're at the end of this Ponzi scheme of, continuous loose monetary policies to contain this bubble that we're in. So could you address that a little bit?
Well, I think that when you go back in the history books, they have to open up the spigot. There's no doubt about it. It has to be done, and it's going to be done on a coordinated basis. So I think that investors have to recognize there'll just be great opportunities through this big, massive correction we're weathering. But the real assets will come back. Gold sold off in 2008 and then came roaring back for many, many years. As it ran from $700 to $1,900. I think that gold is going to trade through $2,000. I hear that silver coins, gold coins, physical coins there's a shortage. There's a shortage with the mint for silver coins. So there is buyers, but the futures market and the fear for liquidity has basically knocked it down. But I think the underlying bid is very, very strong, and the physical demand is going to be robust. And I was just at the BMO conference last month, and Barrick's chairman and CEO was showing peak gold is here. It's so hard for these big companies to maintain their supply, so they're going to have to make acquisitions. It's very hard to find new discoveries. So I think that you're going to see that gold trades higher, and it's going to start to trade like something like palladium, because palladium went for many years of a shortage of supply, and then all of a sudden the demand kept growing each year, and then it's now palladium with the $2,700 last year. So I remain really bullish about the gold sector. The gold stocks are going to have a fabulous quarter, and the year over year is going to be awesome when you take a look at revenue per share growth, free cash flow, returns on invested capital. They're going to far outperform this quarter most of the S&P 500 stocks. So I think that gold stocks are having a big surge today. But one of the real systemic risks are these ETFs. Because if there's such a push to buy just ETFs and not active management, then these calamities take place, because what's happening is that 70% of day trading today are quant funds looking for negative news or positive news, jumping in for a 24-hour to 48 horizon, and they're sparked predominantly only in big cap for liquidity, but it creates this incredible volatility that they've turned around for the Van Eck near their short-term tax-free ETF that it's illegal to short. You can't short them now because there were tremendous whipsaws taking place. So I think there's going to be a real question that the swing to only ETFs, only zero cost, is creating its own systemic risk, because certain sectors should have them. They're very valuable. They're helpful. But the fact that active management was being pushed away, they're performing much better in this sort of system that we're dealing with.
In speaking to what we're seeing with the gold and silver physical markets, obviously the premiums now, I mean, I'm looking online for Silver Eagles, and I see, at the lowest about $20 an ounce. I mean, eBay I'm seeing $40, $50. Some people are trying to get $90 for a silver eagle. But the major bullion dealers, I mean, they're selling it for 21, 22, $23 an ounce. Meanwhile, the spot price is $12 an ounce for silver. And on a day when silver was down double digits percentage wise, we saw the miners up double digits. And so, I mean, what is that telling us as investors? I mean, what does the insiders know? And what's the disconnect between the physical price and the paper price, and obviously what's happening to the underlying miners? And I'll put this out there as well. I mean, we're seeing the GDXJ up about 50% in the last 3 days, while metals have been getting, slammed on the paper price.
And we saw them get slammed last week, where on Friday the GDXJ fell 25%. And so that idea of most people not playing the individual names, of just going to play this basket of ETFs, is creating these incredible volatile situations. And I think that what we have to do is see more active fund flows going into gold funds, mutual funds, and they themselves cherry picking the better quality stocks. That part of the ecosystem has been pushed aside. So I think investors have to recognize that. So it provides great opportunities for you. So those stocks that get crushed, when you know that they're going to have great metrics, all of a sudden they're the ones that surge back at phenomenal quickness. And so I share with you this volatility is just a great opportunity. And I think by June, with gold pushing $1,500, $1,600 an ounce, that we're going to get a 3-year number of growth in revenue per share and growth in cash flow. In fact, I was looking at Newmont for the past 3 years. Their revenue per share hasn't grown, even though gold has gone up $500. And so they've had to get rid of mines, they've had to rationalize, but the market really pays companies that have revenue per share growth. So when we look at some of these gold stocks like Gran Colombia, they have great revenue per share growth. So that's a stock that is very, very inexpensive. They're piling cash every quarter. You can see them from 3 years ago have a debt of 45 million. Now they have 145 million in the bank. They're the stocks that are going to outperform in this next wave.
Frank, let's turn the conversation to the crypto markets. Many people have seen Bitcoin, and many people got into Bitcoin because of a sound money vehicle. This is something that would perform well in a crisis. And there's a lot of questioning of its status in this moment when we are seeing a crisis happen, and Bitcoin going from $9,000 to below 5,000. I believe we're in the $5,000 range for Bitcoin at the moment. What is Bitcoin's role, and is this a short-term thing? Are people losing faith in it? Is this something that where we could see Bitcoin go to $1,000 because people just pull the plug on it and just leave it by the wayside? What are your thoughts on this?
I don't think Bitcoin is going to go to zero, or it's not going to go to 1,000. I think over time it's going to become a collector's item. It's going to be like having an Andy Warhol print that first came out, say, of Mao for $1,000, that went to $250,000 a print. That's what's going to happen. And where I think Ethereum is going to be probably more of the contract, the idea of a smart contract is going to become more valuable, because other countries that are looking at having a cryptocurrency are using that algorithm. They're looking at Ethereum as the proxy, and all the altcoins used Ethereum as a proxy. So I think we remain, it's very bullish, Kenneth, on this size. But what happened, remember, is China imploded first, and most of the Bitcoin mining was taking place out of China. So we saw first the coins drop, and then the coins took off because all of a sudden the hashing power fell, because China's no longer participating, and they're not selling coins, or because they're not mining, and the rest of the world remains strong. Then this virus all of a sudden started to spread to Europe, and then to the US. And all of a sudden now that's created an impact of the psychology of investors and traders around the world. So I think that this is just one of those temporary phenomena that's taking place. And HIVE blockchain last year, we went through a proxy battle. We got that settled. We got control of our assets. We did everything that was right. But large funds in Canada had big redemptions, and they trade differently, Kenneth. Before, they would turn around and take a block bid. They don't do it. They just spray it every day like a Gatling gun. So we had until the end of December something like 60 million shares sold down to the stock down to 10 cents. When that was gone, and then in mid-January, Ethereum explodes above the 50-day, HIVE exploded too. HIVE went up 500%. Our volume went up 500% because HIVE is a real proxy on the crypto space as a stock for Ethereum and for Bitcoin, but much more so for Ethereum. And we can see that. We still even see then Ethereum goes up from basically 125, it runs up to 280, and then it comes back down here to 112, and HIVE comes right back down with it. So I think any pop-up in the Ethereum space over the next 3 months that we can see, we have the potential to see HIVE to double, triple, quadruple. Because it is a proxy. It trades very liquid and over the counter in the US and also in Canada. Some days it was 30 million shares, and it also trades in Germany. So I think I'm really happy about it, what we've been able to do with this company. We have basically 3 employees. We're doing close to $10 million of revenue per employee. And we're just managing along as we look for acquisitions and opportunities.
So I'd like to ask you a little bit more about that. Tell us about, how HIVE plans to navigate this environment, and what the game plan looks like over the next few years.
Well, I think that HIVE's liquidity is a currency on its own, and I think I've seen some of these other stocks get halted. There's no trading liquidity with them. The halving that's going to take place at the end of May, that's impacting a lot of the other particular Bitcoin miners. And I think that there'll be opportunities for HIVE to buy people, to merge with them, and drive that model we have. We really want to be like a royalty company. We really want to have the highest revenue per employee in the space. So I think between now and September, there's going to be just wonderful opportunities for us to explore and capture.
I'm really getting the sense, Frank, that you're getting ready to accumulate, and you are accumulating in this moment. You're taking this as the iron's hot, and you're ready to strike. I mean, you talked about the airlines, you talked about what we're seeing in the miners. I mean, what we're seeing in the crypto markets. It really is that blood in the streets. And then you have Warren Buffett over there, probably deploying who knows how much of that $125 billion that he's had on the sidelines with Berkshire Hathaway. I mean, this is going to be a game changer moment. I think we'll talk about for many years, and some people will be wiped out, and others will make out really big in this moment. And I really think it's going to take that resilience for people to get through it, because how many people are going to sell their $5,000 Bitcoin in this moment because of financial struggle or fear? I mean, when you're actually dealing with what is going on around you, it's much more different than looking at a chart of 1987 and going, oh, this is what everybody should have done. But when you're in the moment and you got to deal with the motions up here, that's a whole different ballgame.
It truly is, Kenneth. And one of the things I've always advocated, I prefer government, rather than government bonds as money funds, I prefer short-term tax-free, and that's why I created NERX, which is basically like a $2 NAV. So it's very, very stable on a relative basis to any of the volatile bonds. But states have to balance their budget. So if you're worried about federal governments around the world running amok, just focus on good munis from states that show the discipline of balancing their budget, and their yields are more attractive. And the rule of thumb is this: if you're 50 years old, I suggest you 50% in short-term munis. If you're 30 years old, only 30%. If you're 70 years old, 70%. The remaining 30% is to speculate in markets or buy dividend-paying stocks, whatever you want. But make sure that your age is related to how much you have in short-term tax-free, and you actually weather these storms exceptionally well. You weathered the 2008 crash. You weathered what they call the Y2K tech crash. the short-term munis end up doing exceptionally well, and whereas other people pile into equities that have no cash flow or no dividends and they speculate, they're the ones that really get punished. So each year you get older, you should just slightly increase that exposure to short-term munis.
Good word there. Frank Holmes, everyone. Frank, if people want to learn more about you, U.S. funds, HIVE blockchain technologies, please let them know where they can go and what they can expect to find. And thank you so much for coming on the show and sharing with us your years of expertise.
Well, thank you. I think that it's simple. It's U.S. funds, like money, usfunds.com. Subscribe to the Investor Alert. We have close to 50,000 readers around the world from 180 countries. We write every week about what's impacting capital markets. And I think that these every big down day between now and July is going to be a great time to buy stocks. So wait for these real downdrafts and commit to buying.
Yes, sir. All right, Frank, thank you so much. You have a tremendous day, and thanks for cheering me up. I actually feel better. I started off this interview a little bit gloomy, but I actually feel better 30 minutes later.
Thank you for your kind words.